Good morning, everybody, and thanks for joining us for our webinar this morning on low risk options with cash. Jonathan Sheehan is my name. Most of you know me. I'm also joined by my colleague Pat Houlihan, who will come on at the end for 5 minutes of Q&A. So thanks to all of you for joining us. There is a Q&A button in Zoom, so please do put questions to me, and myself and Pat will pick them up at the end of the session. We will be recording this webinar, as you can see, and we will be sending slides out. So if you miss any points in particular, don't worry about it. You'll be able to watch back the video and you'll be able to look at the slides afterwards. So without further ado, I'm just going to go into the first section here. And what I wanted to do is set the scene. Why are we having this webinar? What is the problem? Okay, maybe problem is too strong a word, but there's significant amounts of cash in Irish banks earning no interest whatsoever. And the Irish banks are unwilling to be proactively contacting clients to say, look, you've got surplus cash here in your current account. Would you like to put it onto a fixed term deposit? Effectively, on overnight cash, or what we call current accounts, the rate is zero with Irish banks. As of last week, the European Central Bank increased the base rate to 2.25%. So by the banks doing nothing and by savers doing nothing, you're losing out on about 2.25% of margin on all uninvested cash. Okay, so that's the backdrop here. Then there's complexity for savers and investors in assessing non-cash options, which is exactly why we're having this webinar this morning. And what we don't like to see is when people say, well, I don't like my money sitting in the bank because it's earning negligible interest, therefore I'm going to invest it in speculative shares or whatever it might be, okay? So I'll talk about risk shortly, but definitely we need to look for like comparisons for low risk cash that's sitting in current accounts. And I guess overall, the bottom line is that inflation now is rearing its ugly head again. If we assume 2 to 3% inflation at a minimum over the next few years, if your savings aren't keeping up with that, you're eroding the capital value, death by 1,000 cuts with inflation. So, for every €100 or 100,000 euros or million euros or whatever it might be that a company, a charity, an individual aren't getting maximum return on for low risk, they're losing the purchasing power of that over time by inflation. So before we go into cash, I just wanted to summarize. All our clients on this call here know that we always talk about the different distinct asset classes, okay? We all know what cash is, okay? Bank deposits, post office, cash funds, that type of thing. Then we look at bonds, which is usually seen as a level up in the risk return spectrum. Government bonds and corporate bonds, all other different types of bonds, depending on the maturity, the duration, the geographical area, the sector, but just in base terms, government bonds and corporate bonds. Equities, we're all familiar with equities, different types of equities, international equities, domestic, single stock funds, all the various things, okay? Property, either bricks and mortar or listed property, very straightforward. Private equity really is only for those who own their own business or have shares in a private business. For a lot of people, we would exclude that as an investable asset class, but we do have it listed here because it is one of the 6 options that we look at. And then alternatives is anything that's not in the above 5. So when we're looking at advising clients on a holistic asset allocation perspective, we always look at these 6 buckets. What's the appropriate mix? And then we do have multi-asset funds as well, which would be a combination usually of bonds or equities or 1 or 2 other things. So the purpose of today is really just looking at bank deposits, post office, cash funds, and government bonds. So what are the alternatives to money sitting on deposit? Now, this graphic here is just to show really the risk and return, okay? So the lowest risk, lowest return generally is cash. The next level up, we look at bonds. This is all theoretical now, by the way. Then, kind of as I mentioned, multi-asset funds somewhere in the middle. Then we've got equities, which are higher risk, higher return. Next level up, then we've got like leveraged property and private equity. I've just put this in for illustrative purposes to make sure that people know how much risk that they have, and the majority of a portfolio in cash is obviously low nominal risk and low projected return. But obviously, if everything was in private equity or leveraged property or equities, you're taking on significantly more risk. Okay, so like a sample portfolio pie chart might be, let's say if someone did some analysis with the likes of us, and you decided our target asset allocation is something like this, then you want to make sure that each segment of the pie chart is appropriately invested or allocated. And really, today we're going to look at the cash portion of this. What is the role of cash for everybody or anybody? Okay, so it's the default option for surplus cash fund savings. So people get rent in cash, people get salary in cash, they get bonuses in cash, they get windfalls in cash. So it's always the default asset class. Okay. And then I look at it very simply. You've got cash and you've got non-cash. And everything that's not in cash really should be labeled a risk asset. Okay. Now, you could argue that cash over the long term is riskier than equities because you lose purchasing power. But in simplistic terms, let's just look at cash versus non-cash. And the primary focus of cash is as a building block because you get income in cash. And it's the first layer of a portfolio. Okay, so it's in everybody's portfolio, it has to be. But there's really three purposes for cash. The first is it has to be as a nest egg, an emergency fund. Okay, just you do need cash there at short notice in case it's needed for whatever it might be. It might be business, it might be charity, it might be family, whatever it is. Also an opportunity fund. So people say, well, when markets drop down, I will use cash for X, or I want to give so-and-so funds for this particular purpose. So you need accessible funds. There may not be an emergency, so we call it an opportunity. So it's a good need for cash. But also as a natural diversifier. So if you remember the pie chart I showed in the previous chart, you can't have everything in equities or everything in private equity or property. Having some cash in a portfolio, whether it's accessible or whether it's an opportunity or an emergency fund, it is important to have cash there to diversify so that if markets do fall significantly, you've got a portion of your wealth that says, or your assets that won't fall in line with US markets or UK equities or whatever it might be. And the next question you probably have is, well, how much cash should somebody have? Okay, or how much of their overall asset base should be in cash? And thinking about the pie chart, it depends on the security of your income. So obviously, the more income, the more the less need for cash as such. It also depends on your risk profile. So we look at risk under three headings: it's appetite to risk, your personal appetite to risk. The other one is your tolerance of risk. So if markets fall by 20%, can you tolerate that? And the last and probably most important one is your capacity for risk. So we look at all of our portfolios holistically. So the amount you have on cash fits into the pie chart, which is based on your risk profile. If you're in retirement and you're running a cash flow deficit, you probably do need to have a bit more cash built up. But equally, if you're running a cash flow surplus, be it a business that's actually accruing profits every year, your need for cash might be a bit less because your cash pile is growing every month or every quarter or every year, whatever it might be. And also, we find a lot of people don't look at the holistic big picture. By looking at the holistic big picture, you can see of this portion of my wealth, I'm happy to keep that in cash because I've got all our invested assets over here. So there's lots of factors that enter into the mix. We always say, look at your assets holistically. Don't just look at one account or one person. If it's family, look at everything together across pensions. If it's a business, look at and if it's a business owner owns a business, look at your personal assets in the context of the business assets as well. So you can't make a decision until you look at all the assets and what the profile is, and you categorize them into the different asset classes. And then what we do is we set a target allocation to say, okay, you're overweight cash, so you need to be, over here. That would mean investing in equities. It might be over the opposite, where you've got too much in one asset class and you're going to be disinvesting that. So trying to find that balance based on risk profile and overall objectives. That then gives us a roadmap. So what I would say to anybody here watching this is that don't look at current cash to make decisions on. Look at your target cash allocation based on that type of an exercise. Even just look at the end of the year, what is your target cash position? So there's no point in making big decisions on cash if it's going to be significantly less by the end of the year because you've an upcoming investment coming up, or equally, if there's significant cash coming back to you in the next 6 months, you need to consider what you're going to do with that in due course. So now, 11 minutes into the webinar, hopefully you're clear, or doing this exercise with us or on your own, you're quite clear on what your target cash allocation would be. And one should never fall into the trap of looking at non-cash assets as equivalent to cash, okay? And I'll talk about some considerations in the next couple of slides in that context. So now we want to go through low risk options, okay? So this is the default. Overnight deposits, overnight cash, current account, whatever you might want to call it, that is the default. That gives you full liquidity, so you can access it at a day's notice, but it comes with minimal return, and this is what we need to figure out, okay? Now, the next level up from that is placing funds on fixed term deposit with Irish banks, let's just say, for example, for 12 months. And the bank will give you a far better rate. Let's say 2 to 2.5% would be what a 12-month rate would be. So obviously that's significantly better. However, it does come with illiquidity, so you can't access it. So part of what we advise, or you might decide to do, is allocate enough on term deposit that you're happy with as your fits into your asset allocation strategy, but also that you definitely don't need for a particular period. On post-date savings are great because they're tax-free. There's no capital gains tax or income tax on them. And the term can actually be broken, but you just lose the accrued interest. The biggest caveat with on post is that there's only 3, 5, and 10-year issues, and it's only 120,000 cap per person. But they are worthwhile for putting money aside. There's interest rates available on the State Savings website, and it's something that we kind of say to people, look, if you want to put money away long term, why not just avail of the 120,000 per person? It's actually 240,000 if it's a couple. For a business or a charity, it's only 120,000, but it is relevant, and it doesn't have the dirt tax that retail deposits would accrue. Structured products are something that we're not a huge fan of, frankly, because they're often constructed in such a way that they're complex and there are all sorts of hidden fees and different things. We do see a lot of these being sold around the place. We do look at them on a case-by-case basis. Often, though, the catch is that they would say that, okay, this is capital protected, so you get your 100% back in 5 years' time. Well, actually, in 5 years' time, €100 is really worth about €112 if you factor in modest inflation. So it's only really capital guaranteed if you're told that every 100 you put in is going to be worth 112 in 5 years' time. Money market funds are listed funds, institutional diversified funds, and this is something that Compass do a lot of research and due diligence on these days. You do need to look under the bonnet as to what the underlying holdings are. The next one is direct government bonds, okay? So we hear a lot about these and we do a lot of them because Irish government bonds, direct government bonds, are tax-free. There's no capital gains tax for Irish residents on Irish government bonds. Kind of fits into the same as on post-date savings, which are kind of the same thing. But you do just need to be a bit mindful with maturities. And for example, if you buy a 3-year government bond, you might have got nearly all the return after 2.5 years, and the last 6 months might be pointless holding it. And you do need to play with the maturities a bit. So it's quite a cumbersome instrument for individuals. And if you want to be diversified across periods, you have to have 4 or 5 or 6 of them. So something that we advise on. And then government bond funds are probably slightly higher risk, okay, than all of the 5 above. But they do need to be considered. The structure of government bond funds is actually very similar to money market funds, except you're investing in actual government bonds like the Irish government bond, French, Germany, Spain, or whatever it might be. And the one to watch out for government bonds is that funds that, just to make sure that it's not all in US government and there's no currency hedging. So you might be in US government bonds, which would be safe, but you could be taking on 100% currency exposure. So that's something to just be mindful of. Just a few definitions here, okay? I won't go through all of them, but when you see your slide sent out, it'd be good just to read through these. Risk-free rate of return. The AER is what the annual equivalent rate, what your deposits will earn on a 12-month basis. So the AER for 2 years might be 6%, but that's actually 2.96% for 1 year. That makes sense. Yield to maturity is complex. That's calculating the total return based on all the different factors within a bond. Duration, DIRT tax is the tax we know that we pay on interest savings. And exit tax is tax that we pay on funds, that Irish people pay on funds or companies pay on funds. Charities, Compass have a number of charity clients. There's no tax on charities. So considerations when allocating capital outside your current account. Currency exposure. Don't ever look at sterling or dollar. I heard recently someone talk about all the rates of sterling. You know, the Bank of England or X, Y, and Z, UK gilts are giving this, but they have a totally different interest rate system than we do. And if you do that, then you are taking 100% sterling risk, okay? And the same goes for dollar. So just be mindful of that. You have to look in euro only. Deposit guarantee, okay, so there is only 100,000 per person per bank covered. Unfortunately, in Ireland, we only have 3 real retail banks. So you know, no matter what, you're going to be taking on banking risk. I suppose our job is, if ever we're doing due diligence on a bank, is just to make sure that the bank stands up. You hear a lot about Raisin, non-Irish banks on this Raisin platform. And I think that what's important with that is that, firstly, a lot of the time it's only 100,000 maximum, but also it's just a level of comfort for people. Do they want to be investing big savings in a bank that, you know, is in a country and the bank name he may not even be familiar with? So there's a bit of tentativeness there. Even if you're getting a slightly higher return, there might be more home comforts investing into Irish banks, frankly. So we always also getting access. There's minimum and maximum amounts in a lot of cases. So some of those banks have maximums of 100,000. As I said earlier, An Post has 120,000 per person per issue. Getting access to money market and government bond funds isn't that easy, because you want to get into the institutional share class, and BlackRock and JP Morgan, these managers, have huge minimums that they have with institutional investment firms in Ireland. So then you're adding a layer in. There's a lot of complexities about that, which is again where Compass will advise on. And then a lot of funds actually might be niche and small. So for some of our larger investors, they might go into a fund, but they could be representing a disproportionate amount of the fund, and that would give us liquidity concerns. Risk and pricing. So, you know, if you put X amount on a term deposit with AIB for 12 months, you're told you're getting 2%, you will get exactly 2% before tax. If you go into a fund or even a government bond, they're priced daily. So the price does fluctuate. So it's just a psychological thing for people that, you know, the price isn't fixed, and you have to accept a bit of risk when it comes to any collective fund like that that's traded on a market. Fees are important, okay, because any funds that you go into, so you can buy Irish government bonds directly, and when we do that for clients, there is no fund because you own the bonds directly. But if we say, look, you know what, it would be cleaner and easier just to co-invest with other investors into a globally diversified government bond fund that's regulated and all that, there's obviously a fee for that, an internal fund management charge that comes from units within the fund. Always watch out for commissions. So like, are you investing in a fund but incurring a 1% charge or 2% charge, whatever, going in? That's something we'd always obviously try to avoid. Stockbrokers then, so a lot of these big institutional funds will sit on a stockbroking platform, and we've seen cases where the client is paying top annual management charge, and then they're putting the same funds into low risk money market or government bond funds, but the very return from the fund is completely negated by the layer of fees on top of it. That's why careful planning is very important. Duration is very important. So what is the duration of the bonds? So that obviously a short dated government bond that in Ireland that matures in 2027 has a far less risk than one that matures in 2037, because you're taking duration risk. So don't just look at bonds as one asset class in that regard. And taxes, which I'm going to talk about in the next slide, need to be considered. Okay, so I won't go through this in detail because there's a lot to it, but effectively, whether you're a company investing or whether you're an individual, as I said, charities don't accrue any tax, so this is a moot point for them. But you need to look at not just the rate of tax on income and gains, that is important. The first two columns there talk about the rate of tax on income, and gains in Irish government bonds and on post are tax-free because of the tax system we have. But tax filing is very important, okay? So that if you're investing, for example, in bond funds or government bond funds, you need to let the revenue know, or your accountant or tax advisor know about that purchase. And you also need to self-assess on any income or gains within that. Whereas, for example, if you went directly into an Irish fund, it's their job to remit that directly to revenue on your behalf. So there's a bit of a time and cost saving by doing that. Also, if you're receiving income from coupons, from bonds and things like that, tax needs to be paid on that. And one of the things that people forget as well is that it goes back to the benefit of using Irish institutions and providers, that withholding tax is a big hit. So if there's interest accrued on a non-Irish deposit in another European country, they might withhold a 10% tax on that. And if the Irish double taxation agreement doesn't allow you to reclaim that, that's a lost tax. It's something that is a bit of a catch with dealing with non-Irish banks as well. So tax is very important. Compass, as you know, don't provide tax advice, but looking at your cash low risk portfolio in the context of tax is extremely important. I just wanted to, say a word on money market funds and bond funds, okay, because they're quite similar. They're institutional global funds. They are the same, ultimately the same risk in a lot of ways as fixed term to cash deposits, but they do have daily liquidity. And the mark to market pricing means that it's good and it's bad, because sometimes people worry, oh God, it's down 1% or whatever it might be. But generally, they tend not to be very volatile, and they do allow you to take money back at any stage. They do come with minimum amounts for institutions, but with clients, the bite size isn't 5 million because you're leveraging off the economies of scale that the institution have or the Compass has negotiated. As I mentioned earlier, be mindful of the professional fees negating the return. So don't have a low risk, low yield fund sitting on top of an expensive portfolio. Be mindful of government bonds have slightly more risk than money market funds. So we think the optimum solution is by investing directly into a fund and bypassing the layer of professional fees and stockbroker fees and going directly into a fund and having your fees incurred from within the unitized fund structure. Government bonds, okay, so a lot of people talk about Irish government bonds. So they can be bought at any stage on the market through a stockbroker. Compass do this with clients. And this here has come from the Euronext market, and this is as of yesterday. So these are a lot of the Irish bonds that are currently listed on the secondary market. These bonds trade at a price which is either below €1 or above €1. So they always launch at €1. So this is very small to see, but the price that you buy it at as a point in time, that price then has a coupon associated with it. So it might be in some cases it's 0%, but it might be 0.20%, it might be 1.1%. And the yield to maturity takes in the price you buy it at, the coupon that was actually based on par. The yield to maturity is factoring in those two along with the time taken to when the bond matures. So it's quite complex, and even this doesn't give the yield to maturity. So you want to make sure that you're not just driven by, oh, it looks cheap, but it might be cheap with a short duration and low yield. So actually yield to maturity is quite small. So I am exactly at 11:25. So I had to rush through a couple of slides there. So we've condensed a lot of information there. There's a few other appendices as part of this presentation, which would be useful for you to read. So I'll ask Pat to join us now as well. And we've had a couple of questions that have come in there. And if you have other questions the next couple of minutes, do send them to us. So one question here is actually specifically on the US and on US bond yields. And I guess the question is putting to us, what do we think of US government bonds? So Pat, I'm not sure what you think of that in the context of what we discussed in terms of low risk and how the US exposure sits into the overall the overall content of the webinar.
Yeah, so there's two aspects to that, I suppose. First of all, there's the dollar and the US in the context of it in and of itself, and then there's the context of the dollar from a European perspective. So first of all, from a European perspective, um, I wouldn't be transitioning from euros into dollars just as a straight basis to chase rate of return. If you are a euro spender, focus on euro spending. If you do have a dollar risk or dollar liability or dollar spend coming forward, it might be worth considering such a move, but only if that's in your space. In terms of the dollar itself and the rate expectations, it's a bit up in the air. So the new chair of the Fed is a guy called Kevin Warsh. He is very much a Donald Trump guy. Donald Trump wants rates slashed, but in similar to the rest of the world, inflation in America is proving quite sticky. And where we entered this year with an expectation that rates might drop by 1% in America through 2026, it'll probably end up only being a 0.25% cut with further cuts in 2027. So the expected rate curve has shifted. But that belies the fact that this new guy is now effectively in charge, and he might take lead from Donald Trump, who does want an aggressive rate cut. And that's the unknown here as to how this guy will operate.
We have another question that's come in there, which I'll give to you as well, Pat. Is AER and yield to maturity the exact same thing?
No. This is a very much an honest question and gets into the maths. Not quite. So the AER, the annual equivalent rate, is effectively the rate you'll get over, say, a 2-year or an 18-month deposit. A yield to maturity would be the yield you'll get if you hold a bond all the way to the end of the life of that investment. But if you decide to change your investment plan during the phase of that bond, there will be a slightly different outcome for you. So it's in that gray area. There's certainly similarities, but I could argue differences as well. So my apologies if I've hedged the bets on that one.
Yeah, like I mean, it is a good question because all these acronyms do bamboozle people a bit. And when you're the most simplistic thing is to look at a deposit rate at a point in time and know exactly what you're getting back. But sometimes that does curtail your returns. One of the big themes at the moment that we see is that interest rates now had obviously reduced quite significantly. In Europe, it bottomed out at 2%, and they've gone up now to 2.25%. So it just means that if you're locking into a longer term deposit or yield to maturity with a bond fund in a rising interest rate environment, the question that we would have is, well, if I'm entering into a 5-year return at 3%, that sounds great. But what happens if I put it on 12 months at 2%, and in 12 months' time, will the rate then be 2.75%, and 2 months after that, will the rate be 3.25%? So there's all these different mechanisms, but I would advise everybody to be very mindful of duration. Your duration is 0 in your current account cash, but managing durations and diversifying across time periods is just as important as diversifying asset classes. I'm not sure if you have any comments on that, Pat.
Yeah, like ultimately, the basis of all these discussions and what you receive from the investment return of a deposit account or government bond is driven by central bank decisions, whether they increase their rates like the ECB did last week, or I mentioned the US, where they're potentially cutting rates. And their decision is based off inflation. And right now, inflation in Europe is running at about 3.2%, hence the rate rise last week. In Ireland, it's actually running at 3.6%. And if this gets sticky and it sits around for, say, a 5-year period, 3% inflation will deteriorate cash sitting in current account by about 23% over a 5-year period. So that's the uphill battle that you're fighting against. So if you are in a situation where you've got excess cash and you are not a risk taker and you don't want to take risk, squeezing the margins on your deposit solutions, on your fixed income solutions, is how you're going to offset that inflation argument, but be over that longer term period. So it goes back to the planning. It goes back to what you were saying at the start, Jonathan, about the idea of knowing what you need in the short term as your rainy day fund, knowing what your expected expenditure is going to be in the next 12, 18 months, and then knowing what your risk profile is for 5 years. Because within the context of that, inflation is going to be the primary driver of your outcome, and what you're prepared to take on.
Thanks very much for that, Pat. We're just 31 minutes past, so thank you to all of you for joining us today. This is our new office, by the way, in Merrion Square. All of our clients and contacts are more than welcome to pop in at any stage. Pat is down in our Cork office. Thanks to every one of you for joining. We will send you on a copy of the slides, which does have a few extra slides at the end in appendices. We'll send you on a copy of this recording, and do come back to us with any queries or questions as a result of the contents of the webinar. Thanks to you all, and we'll see you soon.
Thank you.